Smurfing. This is money laundering 101. Let's say you've got $1 million in illegal cash. You can't just walk into a bank and deposit that. It would trigger multiple red flags under anti-money laundering laws. So instead, you break that $1 million into hundreds of small deposits. Let's say $9,000 each. You do this across different bank branches on different days and even using different people. Those people are called Smurfs. Yes, like the blue cartoons. Only instead of singing in a forest, they're quietly stuffing $9,900 into ATMs across town. Smurfing works because many banking systems only flag deposits over a certain amount, let's say $10,000. Stay under that, and the system might not blink. Layering. Once the money's inside the system, you've got a new problem, the paper trail. So step 2 is called layering, which basically means making the money's path so complicated no one can trace it. You wire it through different accounts, you move it across borders, you convert it into foreign currency, you use fake invoices, you buy and sell assets. The goal? Confuse investigators so badly that they give up trying to figure out where it came from in the first place. Integration. Now the money has been filtered and shuffled. It's time to make it look legit. That's where integration comes in. Reintroducing cleaned money into the formal economy as if it came from a legitimate source. How? Buying real estate and flipping it. Claiming it as income from a fake business, using it to buy stocks or bonds. Claiming it as gambling winnings. Reporting it as a loan repayment from a company you control. Once it's integrated, that money can buy anything. A house, a yacht, political influence. And no one would suspect it started as drug money or stolen funds. Integration is the final stage. By this point, the criminal can sit back and spend like a CEO. Cash-intensive business. Now let's say your cafe genuinely makes $2,000 a day from food and drink sales, but on your books you report $4,000. That extra $2,000, it's not from lattes, it's drug money. Bribery cash, fraud profits. You just quietly slipped it into the till, deposited it like it was earned, and boom, it's clean. From the outside, it looks like your business is doing great. You're reporting income, paying taxes, even hiring staff. But behind the scenes, it's a front, a sponge soaking up dirty cash and wringing it out into the system. This method works because it's boring, it's normal. Nobody blinks if a bar says it had a busy Friday night. No bank flags a bakery for a sudden cash boost. Unless someone physically audits the stock, the receipts, the customer flow, it's nearly impossible to tell what's real and what's fake. And sometimes these businesses don't even pretend to be good. The food is terrible, the chairs are wobbly, the location makes no sense. But they stay open for years, burning money because the real profit isn't from what they sell, it's from what they cover up. Trade-based money laundering. Okay, this one's slick. It doesn't involve bags of cash or dodgy car washes. It uses something that looks totally legitimate. Global trade. Let's say you own a fake export company. On paper, you're shipping 10,000 luxury handbags from Dubai to Singapore. But in reality, the container is empty. Or maybe it only has 500 bags in it, but you invoice the buyer as if it's a full shipment, at full value. Why? Because that invoice becomes the paperwork to justify a massive money transfer across borders. The buyer pays the full amount, say $500,000, and that money looks squeaky clean. But the goods never match the price. You just faked value on paper and moved dirty money internationally. This isn't just about quantity, it can be quality too. You claim you're selling premium electronics but ship low-grade knockoffs. Or you under-invoice luxury goods to get them into a country cheaply, then sell them at full price, pocketing the difference. It's not just used by lone criminals either. Entire multinational companies have been caught doing this, sometimes knowingly, sometimes not. Because in global trade, prices fluctuate. Rules differ between countries. Paperwork can be confusing, and most customs agents don't open every crate. That gray area? Launderers love it. Black market peso exchange. Imagine a Colombian cartel earns millions of dollars in the US selling drugs. Now, they've got a problem. How do they get all that dirty US cash back into Colombia without triggering alarms at every bank? Wiring it directly? Too risky. Physically smuggling it? High risk, low reward. So instead, they go underground and use a shadow economy to move that money without ever crossing a border. The cartel hands the dirty US dollars to a black market broker inside the US. This broker's job is to quietly offload that cash by selling it to Colombian business people who need US currency to buy goods from American suppliers. These importers pay the broker's contact in Colombia in pesos. That means the cartel gets clean Colombian pesos in their home country, and the importers get the US dollars they need to legally pay for merchandise abroad. Meanwhile, the broker launders the dirty US dollars by buying legitimate goods like clothing, electronics, or food, exporting them to Colombia or elsewhere, getting paid on the other side in clean, legitimate pesos. It's like a money swap with a twist. No cross-border transfers, no names on bank wires. Just two parallel money flows, one legal, one not, both happening in sync. And the reason it works so well is that every part of it looks normal on the surface. Colombian importers do need dollars, US goods do get shipped, and businesses do pay for inventory. But behind the curtain, the cash is cartel money, and by the time it hits a bank account in Bogota, it's clean as a whistle. Real estate laundering. You've got dirty money to clean, and real estate is the perfect cover. No one questions big transactions in property, especially when they're routed through companies or trusts. You set up a shell company, buy a $3 million flat, then sell it later, maybe even to yourself through another shell. On paper, it's a normal sale. In reality, it's the same money doing a lap around the block, now looking squeaky clean. You can hold the property, rent it out, or flip it. Either way, the money re-enters the system as legit income or capital gains. And since property values are subjective, and buyers can stay anonymous in many places, it's hard to trace where the money came from or who's really behind the deal. That's why so many luxury homes sit empty. They're not homes, they're hiding places. Shell companies. This is the Swiss Army knife of money laundering. Versatile, quiet, and incredibly hard to trace. A shell company looks like a real business. It has a name, maybe a website, a bank account, but no employees, no office, no product. It exists on paper, and that's the point. You create one in a place with loose regulation. Think Panama, Belize, or the British Virgin Islands. That company opens a bank account. You move money through it. Maybe it pays another company you also own. Maybe it receives fake consulting fees. On paper, everything checks out. In reality, you're just bouncing money between empty shells. The brilliance is in the layering. One shell company owns another. That one owns an apartment. That one receives a wire from Dubai. By the time anyone tries to follow the money, they're tangled in a web of offshore filings and nominee directors. Shell companies aren't illegal, but when they're used to hide identities, disguise ownership, or invent fake transactions, they become one of the most powerful tools in laundering dirty money across borders. Bank complicity. Sometimes criminals don't sneak around the banks. They go straight through them. In this method, the laundering doesn't rely on fake companies or shady invoices. It relies on people inside the bank who are either corrupt, careless, or simply don't want to know. Here's how it plays out. A criminal sets up accounts and starts moving suspicious amounts of money. Millions, sometimes billions. Instead of flagging the activity, a banker waves it through. Maybe they're being bribed. Maybe they're following quiet instructions from above. Or maybe they've been trained not to ask questions when the client's wearing a suit and calling from a skyscraper. Offshore accounts and tax havens. This is the classic move. When criminals want to hide money and hide themselves, they go offshore. And an offshore account is simply a bank account held in another country, often in places known for secrecy. Think Cayman Islands, Switzerland, the British Virgin Islands, Panama. These jurisdictions don't ask a lot of questions. They don't share information easily, and in some cases, they don't even require you to reveal who owns the account. So here's the play. You set up a company in one of these havens. That company opens a bank account. Dirty money gets wired in. From there, it can go anywhere. Into stocks, real estate, other businesses. And since the company name is on the account, not yours, good luck connecting it back. The real power of offshore banking isn't just in hiding money. It's in hiding ownership. You can have a luxury property in London, a jet in Dubai, and a stock portfolio in New York, all technically owned by companies in places where no one's allowed to see who's behind the curtain. It's legal to have offshore accounts, but when they're used to disguise dirty money, they become the perfect vault for laundering wealth behind layers of fog. And that's it, guys. Did you enjoy this breakdown? Then subscribe and hit that bell for more.